Well, hello everyone. My name is Kim Urbanowski, and we're here at the ONTV studios. We're bringing you a combination of a couple different things today. We're using some new technology with ONTV, and the Chamber of Commerce is bringing you a tax reform seminar with my good friend here, Jamie Lopiccolo. Jamie, tell us a little bit about yourself before we begin.
Sure. I'm the managing member of the Capricorn Professional Advisors. We're located in downtown Lake Orion. I've been a CPA now for well over 20 years and approaching my 30th year in the industry. So, and have taken a lot of updates on this section and ready to prepare it.
Good, excellent. So if you're tuning in right now, we're doing this live, of course, on Facebook. We do have some people in the studio who will be asking questions. But if you have questions for Jamie, please go ahead and type them into the comments below, and we'll make sure that he gets your questions answered for you. So with that, we're just going to hand the floor over to Jamie and hear all the good things about tax reform.
Exciting stuff. Thank you. Thank you, Kim, and I want to give a thank you to the Chamber of Commerce and ONTV for allowing me to present this presentation today on the tax update from that was passed in December of 2017. It went into effect for 2018. It was based upon the premise of being a simplification of the tax code. However, after we've dived into it, we've kind of coined it the most complicated simplification in history. There's a lot of things that they've done to simplify, but there's a lot of things that they've added that have complicated the tax preparation. Today's presentation, I'm going to try to divide into two sections. We're going to divide into the individuals and then divide into the businesses. Depending on the questions we have, we'll take questions after or answer questions after the individual presentation. Maybe we'll take a couple-minute break between the individuals and businesses, depending on how the questions are flowing and so forth. But some of the major provisions that that occurred on the individual side, the funny thing with the individuals is they actually were never made permanent. The individual changes were designed to be suspended. The old rules were designed to be suspended, and then if the Congress doesn't do anything since at 2025, then all of the old law will come back into play. So what they've done, though, is they've suspended the tax rates and introduced new ones, suspended the standard deduction, the personal exemptions, changed the child credit, changed the itemized deductions, and then did some changes to the Section 529, and we'll go through those in detail. On the business side, they've introduced this new concept of a qualified business deduction for pass-through entities. I'll go into more detail on that. A new corporate tax rate for businesses, depreciation adjustments or deductions on capital expenditures, limited interest, meals and entertainment changes, and some small business exemptions, and then a alternative minimum tax changes for corporations. So getting started into the individuals. As you're going through this process, Senator or Speaker of the House, Paul Ryan, had made this statement. We're making things so simple. We're making things so simple that you can do your taxes on the size of a postcard. Well, here's your postcard. So the new tax form is actually going to be a half page, front and back, so it's not a full postcard. It's a larger postcard. But they did fulfill, I don't know if this is actually going to be, this was on the IRS website as a proof. So we're assuming that this is going to be the new form for filling out your tax return. However, you've got a postcard. We've now got 5 new schedules added to this postcard. So you've got schedules that are going to roll up into this postcard style form. So they've really just kind of moved them around. And if you're getting your taxes prepared based on the form, you can probably see your fees go up just based on the additional schedules that are going to be there. So again, trying to make things simple. In the individual, the biggest change is the individual brackets. We still maintain our 7 tax brackets. However, they've changed and the income levels have changed as well. The 10% pretty much stayed the same as it was before. The old 15% became the 12%. The old 25% became the 22%. The 28% dropped 4 percentages to 24%. The 33 dropped to 32%. The 35 remained the same. And the 39.6, or the highest rate, dropped down to 37. The other thing to note is that where the brackets start to kick in for individuals, as a married taxpayer, you hit the highest bracket prior to the law at 39.6. It's somewhere in the neighborhood of about $470,000. Now you're not hitting the highest bracket till about $600,000. And you can also notice the little bit of the disparity between, it's not an exact single and married is not exactly one half, so there is still going to be a little bit of a marriage penalty as you start to get into the higher bracket. Capital gains did not change, or the qualified dividends. They still remained 15 and 20%. The net investment tax, or the tax on some investments based on your income, remained the same at the 3.8%. The other thing that they did, it's not a major thing, but the way that they index the rates are now tied closer to CPI, a different formula of CPI versus what they've done in the past. Standard deduction. This is a big change. Before, the standard deduction for a married family was $12,700 for 2017. They've now almost doubled it to $24,000. The standard deduction is the deduction the government gives you over itemizing. So you take the larger of the two. Either you itemize your deductions or you take the standard deduction. By increasing this to $24,000, I'm anticipating that most people now will no longer itemize their deductions, because this will exceed most people's itemized deductions. This has potential for eliminating the benefit of the mortgage interest and the property taxes of purchasing a home, and then will be not a real big win for those that couldn't itemize or were able to itemize in the past. So it's going to be interesting to see how this goes as we go through the 2018 tax year. The dependents, they have been technically suspended. The dependents have been suspended for until 2025. That means that there's no longer a deduction for yourself, your spouses, your kids, and you never were able to take your dog, but I've had that question many times. What they've done is they've eliminated, so you've got you end up having is a larger standard deduction and no dependent deduction. It almost, to some, it will wash itself out depending on your income. However, they've tried to offset some of the loss of the deductions for the children by increasing the child tax credit from $1,000 to $2,000. They've also increased the phase out of who can take this credit from about $115,000 married to $400,000. So now there's a big range of people that will be able to take this credit that were never able to take it before. So it's going to help offset some of the dependent deductions that they've lost now. There's also an additional $500 credit for a dependent of a non-child. So if your parent is a dependent or deemed to be a dependent of yours, you'll get a $500 tax credit, not a deduction, a credit. A credit is more beneficial because it's a dollar for dollar reduction of your tax. There's also the change in what's refundable in the credit. It actually lowers the amount that's refundable on this credit going forward. State and local, I'm assuming a lot of people have heard changes relative to the state and what's going on with state and local taxes. When they originally passed this law, or we're talking about it, the loss of the entire, for what we refer to as SALTs, state and local taxes, was on the table. During the negotiations, they brought it back on, but limited the amount of deduction. So the limit goes to $10,000 for a married filing joint return, or $5,000 for a single return. So this includes property taxes, withholding taxes, your auto tabs, anything that is related to taxes is going to be capped at $10,000 regardless of how much you have, or $5,000 if you're single. The impact to Michigan residents is that we'll see if anybody that has over $150,000 of income, chances are you're going to see your taxes being limited on the deduction. Also, those people that live in high tax states, such as California and New York, will be affected, and those that live in high property tax cities, and even in Michigan, the Birminghams, the Grosse Points, the Detroits, that have large tax bills, they're going to see a limit on the benefit they're going to get out of these. So one of the things is a planning opportunity is if you've got a secondary home, They haven't changed these rules as the deductibility when it comes to businesses. Businesses are still able to deduct their state taxes and property taxes if it's income producing property. So something to consider is what do you do about a second piece of property? Do you try to make it income producing where you get some deduction of your interest or your state taxes that you pay, your property taxes that you pay on that? It becomes an interesting planning situation to look at. And this deduction alone is typically what I see in my clients, their largest deduction. So what I'm anticipating is a lot of clients are going to be forced back into that $24,000 standard deduction just because you're only going to be limited to $10,000 in state taxes. So it's going to be hard to get to $24,000 on the itemized deduction just based on this alone. You guys may have heard in the news that I believe some states are trying to treat their taxes as contributions to the state. So it's deducted as a charitable donation. The IRS has recently come out and said that that's a no-go. They're not going to allow that. So, but the states will continue to try and figure out how to make these deductible for their residents. Mortgage interest. The effect of mortgage interest is really affects those that had the $1 million mortgages, the large, maybe the higher income earners. Before, under the old law, you were able to deduct interest associated to $1 million of interest expense, or the $1 million of loan. You could deduct the interest on $1 million of a mortgage. They've lowered that $1 million to $750,000. They take effect, anything prior to the law is grandfathered in. So we don't have an issue relative to that. It's any new mortgages that are obtained after the law are going to be affected. Now, even if you had a mortgage prior to the law and you refinance it, as long as you don't take out more than the original note, then you'll be fine. And then what they have done too is they've limited the deduction relative to home equity loans. Home equity loans in the past, you were able to take out $100,000 of a loan. You were able to do whatever you wanted with those proceeds, and you'd be able to deduct that interest. Under the new law, the home equity loan is no longer deductible unless it's used for what we refer to as acquisition and debt, meaning that debt used into the improvement or buying of a home. However, that home now has to be secured by the property. So for example, if you take out a $250,000 home equity loan to buy a vacation home up in Traverse City, if it's not secured by that home in Traverse City, it's going to be a non-deductible home equity loan because it's not secured by the property in which you used the proceeds to buy the asset. So that's a big change going forward as well. Charitable donations, they touch these a little bit. Again, I think this is designed for a little bit more of the high income earners, but in the past you were able to deduct more, charitable donations up to 50% of your income or your adjusted gross income. They've upped that to 60%. I don't know where that came from, but they just decided to do that. I've very rarely ran into clients that have had that issue. You've got also the big thing here is a lot of U of M fans are probably a little bit sore on this one, but in the past, U of M used to, in order to buy season tickets, you would actually make a contribution to U of M, and that gave you the right to the season tickets. They've now taken that off the table. That is no longer considered a charitable donation. So the season tickets to the various colleges and athletic departments are no longer a deductible expense as an itemized deduction. Again, I think a lot of these itemized deductions are going to go away anyways because of the standard deduction for most people. The other little caveat they throw in there, in the past, going back several years ago, any contributions over $250 required an acknowledgement by the charity. Then they changed the law that said no, all payments to a charity needs to be acknowledged. They've now repealed that portion of it, and we're back to just $250 or more per contribution needs to be acknowledged. So you may not see these, thank you for your $50 gift anymore. You're going to need to keep track of your receipts and your checks and so forth to give your tax preparer. Miscellaneous itemized deductions. This is huge. They've been eliminated or technically suspended unless they make the law permanent. This is your deductions for tax preparation fees, for investment advisor fees, for union dues, and the big one is for unreimbursed employee business expenses. I have a feeling that a lot of salespeople that do a lot of their own expensing are going to have a hard time with this law because they're no longer going to be able to get the large deduction for unreimbursed expenses that they used to in the past. What I'm trying to recommend to my clients is to go back to your employer and maybe try to look to somehow renegotiate your compensation package to include maybe a lower compensation, but they're going to reimburse you for some more of your expenses. Get those expenses paid by the company versus paid by you. That's going to be a big issue. The other issue is maybe you somehow find a way to no longer be a W-2 employee, but you become an independent contractor or an independent commission salesperson, and then you expense those as part of against the commission income. The one caveat to this is they have allowed these expenses to go for the armed forces reservists. Those expenses incurred for location of government officials and things of that nature, expenses. I think that they were trying to appease a little bit to our armed services, rightfully so. Moving expenses, those are no longer deductible either. They've been eliminated or suspended, which will require those that receive employer-assisted relocation will now be considered taxable compensation to the employee. Again, this may be an issue that maybe you look back as you're buying a house or negotiating, you look to get some of that money recouped in the negotiation of the seller and buyer. Again, there is an exception to this law, which is again going towards active military. So again, I think the premise here is they did not want to alienate military in this new tax law. A little caveat on what's referred to as Section 1031 exchanges. Those were typically like-kind exchanges. If I decided I had a piece of property and I wanted this piece of property, I could go in and maybe exchange it and defer the gain until later, until the property is sold. It used to be on all property. Now under the law, it only applies to basically business property, or I'm sorry, to real estate business property. Yes. Oh, thank you. Hi, John. So one of the selling points of the Republican, the TCJA on the Republican side is that they threw in there that they were going to eliminate the mandate for the Obamacare or the Affordable Care Act. In reality, what they did is it didn't eliminate the mandate. It just reduced the penalty for not having insurance to zero. So in the past, if you didn't have insurance on your tax return, there was a penalty, and that penalty escalated every year. The penalty now is zero. So it's kind of like getting pulled over for doing 75 into 65 and the police officer giving you a ticket for zero. Same thing. So you still have to report that you didn't have insurance, you're just not going to get fined for it. And the self-employed insurance is still deductible to self-employed. Some changes, a little bit of changes to the education. 529 plans now can be used for private schools. This is good news for those that have younger kids in private school or parochial schools. They can be used for those tuitions. They've allowed for forgiveness of debt on student loans in the cases of death or total disability. They didn't want to have the families to continue on with that obligation. And then the 529 plans can be transferred over to an ABLE account. An ABLE account was created a few years back under new law that is really works for disabled family members, allowing you to save up money into almost like a 529 plan, but for disabled and for other long-term down the road type needs. Little odds and ends on the individual. Casualty losses are only deductible now if they're in federally declared disasters. So no longer if your basement floods and it wasn't a disaster area are you able to claim a casualty loss. The alimony deduction and inclusion of income has been eliminated for all divorces after 2018. So I guess you got to time your divorce. So we already talked about the moving deduction, and then there's some retirement changes. no longer able to recharacterize Roth IRAs after the conversion. Typically, what you've done what you're able to do in the past, if you were able to convert a traditional IRA to a Roth IRA, which is a non-taxable over time IRA, what they would do is if you did your taxes and realized that it was non-beneficial to do that, you could recharacterize it by the filing of your return, and it would almost look like nothing was ever done. That now has been eliminated, so you need to think twice before you decide to convert over to the Roth IRA and try to think of what other implications you may have down the road. Extensions of the rollover period for the plan, those are just allowing, what would happen is people would have loans and they would leave a company and it would immediately become taxable to them. They're now giving them some time to take care of those or to do something with those. So that's just a little caveat for those that have got 401k loans and are looking to switch jobs. So that kind of wraps up the individuals. A couple comments on the overall scheme of the individuals is I want to say that the Congress took all of the pain points relative to IRS examinations and what the IRS had to enforce and just said, we are going to make it simple. We're going to eliminate all of it. If you look at the coming up in the business side, the meals and entertainment they've eliminated, and then a lot of the itemized deductions they've eliminated because those were, for the IRS examinations, those were more pain points. So I have a feeling this is also to kind of allow for the IRS not to have as much interaction with taxpayers because, again, their returns are going to become much more simpler, at least on the deduction side. If we noticed for the individuals, they really didn't touch the income side of things. It was all based on the deductions. So there's still room for simplification, but they've done a good job starting out so far. So I think we're going to take a couple minute breaks. I don't know if we have some questions.
We have a comment
Sure.
here or a question. Let me read it. If I was divorced before December 31st, 2018, I still have to claim alimony and it is taxed on my return.
Yes. Yes. As far as mine,
Oh, I'm sorry.
you'd want to read it
Do
again?
you want me to? I'm sorry. I'll say that again. If I was divorced before December 31st, 2018, I still have to claim alimony and it is taxed on my return?
Yes. Yes. It'll still go forward. I think that there might be a phase of where they phase it out, but it's still going to be deductible at least for 18 or taxable for 18. Is that it?
Yeah.
Okay.
Do you all have any questions?
No, I'm good.
Good? Good? Okay. Don't want to put anyone on the spot. Okay. With that, we can continue on with the moving on to the business tax side of it. This is where I think this will have the biggest. This part of it will have the biggest impact to our fellow chamber members and business owners. They've now. President Trump was really concerned about our competitive standing in the world, and one of the things he felt was prohibitive was our corporate tax rate. The highest tax rate for corporations that paid at the corporate level was as high as 35% of your income. That left businesses roughly 65% of their profits to be used to reinvest or to use as they need be. They've now lowered the corporate tax rate to a flat 21%. So this is good news for those businesses that had income over $100,000 every year, because they were in the starting to creep into that 35% rate. However, those businesses that only had maybe about under $50,000, they're actually going to see a tax increase, because the corporate tax rate at $50,000 was 15%. So now we've gone into a 21%, so they're going to see a 6% increase in their taxes for those businesses that were running profits of $50,000 or less. The personal service corporation tax, this was a tax on those that were doctors, dentists, accountants, anybody that was considered organized under the state law of a professional service corporation. They had a flat service tax from $1 of 35%, and now they are now equalized down to a 21%. So those doctors, dentists, and lawyers that were formed as corporations a while back will see some relief relative to the tax rate. And actually, now this brings up a interesting challenge to those practitioners, and even practitioners now, is do we can start to convert our entities or start looking at if a C Corp makes sense for our entity? Sometimes you have to go through the analysis, and it's a complicated analysis. That's why, again, even though this is a simplification, it does make some complications on the business side. Talk to your tax preparer if a C Corp makes sense for you. They got rid of the AMT tax. For business owners, the AMT tax was just an alternative calculation. It was really just a pain. They got rid of it, which was I'm glad to see. It's always a tax that snuck up on people and you never really were able to plan for it. Dividends received deduction has been reduced from 70 to 50 and 80 to 65. This is a deduction for those businesses that maybe owned another business or had investments in other U.S. businesses, and they received a dividend. To help alleviate some of the double taxation, you were able to get a deduction for part of it. However, they've limited the amount of the deduction for the dividends. So it will see some businesses that do have these type of arrangements or investments will see a little bit increase of taxable income based upon their investments in other corporations. And of course, with anything, when they change the rates, there'll be a blended rate for those that are fiscal years. This all took effect 1/1/2018. So if you have a fiscal year ending in the middle of 19 or even 18, you'll take a blended rate of the old and the new into account. This one's kind of interesting. This one I kind of like. This is the small taxpayers defining what is a small taxpayer and changing of accounting methods and so forth. Prior to the law, any businesses under $10 million were considered small businesses, and that allowed us some freedom as the sense of choosing a cash method of accounting or an accrual method of accounting, whether we account for inventory or not, and some other overhead allocations and things of that nature relative to determining their taxable income. And then what happened once you got over 10 million, now all of a sudden you had to go on to a formal accrual method. So what that means is if you had accounts receivable, that becomes taxable because of the recognizing it and so forth. This now moves that bar from 10 to 25 million, which now puts in a lot more businesses, small businesses, in that realm, and they don't have to worry about how they account for inventory or accounts receivable when it comes to paying taxes. So this was nice to see. I've had a few clients that creeped over the 10 million this year, and this was a welcome change for them. Business interest deduction. Well, this is going to follow the small business definition of who applies to, so it's not going to affect most people under 25 million in gross receipts. However, if it does affect them, what's happening is they wanted to eliminate the interest deduction or the debt relative to lines of credit and operating debt versus financing and investment style debt. So the deduction limits to the interest income for the year plus 30% of your taxable income plus your taxpayer's financing interest, which is interest-based financing on new equipment and things of that nature. A little technical, this is limited to the taxpayer level, not at the business level. So for S Corps and partners of partnerships, it's going to be determined at your level, not at the business level. Whereas a C corporation is going to be recognized at the C Corp level. And then anything that's not used is able to be carried over indefinitely. Again, I don't see this as a big effect to a lot of businesses. The General Motors of the world and things of that, this will have an impact to them. However, I think most of our membership and chamber and small businesses in the area won't see much of an impact. Depreciation. I remember when I first got into accounting, depreciation was just a simple process. You took an asset and you divided by 7 years, and that was your deduction. It's now gotten complicated. This is not this is no longer just a simple process to go through. This requires some understanding of the law and requires some ability to kind of foresee how to best use this. We call it almost depreciation by design, meaning there's ways that we can just determine how much depreciation or how much of an expense of an asset we get to take for businesses. There are two major provisions under the law. Bonus depreciation in Section 179. Bonus depreciation came into play after 9/11, where President Bush wanted to encourage investment into the United States. And so he allowed businesses, regardless of size, regardless of income, to take an immediate expense of the assets they place in service immediately in that tax year or a portion of it, thus creating bonus depreciation, kind of helping try to spur some of the economy, and it worked for a while. And now this has kind of grown into its own thing, and like any new tax rule, it's hard for it to go away. So what they've done under the new laws is they've allowed for 100% expensing of any capital asset all the way through December 31st of 2022. So if you buy a $100,000 piece of equipment, you get a $100,000 expense versus spreading it out over maybe a 7-year period. The old law only applied to brand new property, again, trying to spur new investment into the country. The tax change now applies to used equipment or used property. So this is going to be a welcome change for those that constantly buy used equipment as part of their operation and business plan. The one thing that this differs from some things is it doesn't include real estate. You can't take bonus depreciation on real estate, but some leaseholds, like the walls inside and some of the build outs that you do, may qualify. However, I'm putting you see that pending a technical correction. There's a lot of, this law was kind of rammed through at the last minute. Nobody really read it, and now as we're reading it, they're realizing that they need technical corrections. The problem you have with technical corrections is the way that the law was passed, it requires well over a majority of the Senate and Congress to pass. And we have 51-49. We're not getting anything over 60 to pass on this. So we may not get this for a couple years. I don't know if they'll make it retroactive or not, but we've still got some, they've still got some work to do on this part of the law. Moving into the Section 179. Section 179 is very similar to bonus depreciation, but it's got some limitations to it. The bonus depreciation, or Section 179, went up from $510,000 to $1 million. So if you buy $1 million worth of equipment or assets, you could immediately expense them in the year that you buy, as long as you don't exceed $2.5 million in total expansion. So that's where the limitations come from 179 compared to bonus depreciation. The Section 179 is qualified real property, including, does include the non-residential real estate such as roofs, HVAC systems, and so forth, which would not qualify under bonus. So that's where maybe somebody may use Section 179 compared to bonus depreciation. And on the flip side, bonus depreciation can be used even if you have a loss, whereas Section 179, the deduction is limited to income. So I can't use Section 179 to create a loss, where in bonus depreciation I can. So what this gives, this is a great tool for the tax preparer in being able to manipulate the business's income, especially if they've gone through a period of high equipment purchases in a given year. Allows them to decide how much of a profit I want to have, if not, because between these two tools I can make depreciation pretty much whatever I want it to, within reason obviously, and then get my client's income to where I want it to be. And so these are two great tools if used properly, but it's no longer something that's just very simple and should be ignored anymore. So meals and entertainment. This is the fun one. Prior to the law, meals and entertainment were grouped together and they were 50% deductible. Anything that you did relative to taking clients out to sporting events and dinner or whatever, they have now parsed out between meals and entertainment, the meals portion and the entertainment portion. They've said anything relative to entertainment or generally considered entertainment is no longer a deductible expenditure. This includes sporting events, theaters, concerts, skyboxes, suites at the Palace, or what was the Palace, suites at the Tigers and over at Ford Field in Comerica. Those are all no longer deductible. They've even gone so far to say if you incur a meal while at one of these sporting events or one of these entertainment events, that is not deductible either. So so meals are going to be, depending on the facts and circumstances and where the meal occurred, is going to determine the deductibility of it. The one thing that they left alone in this is if you take your entire company out for a holiday party, they're not considering that entertainment. They're allowing that to be 100% deductible because it's for the benefit of the employees. Okay, this is not, so that is still allowed under at least the current law. The meals portion of this, The deduction is allowed for meals associated with active conduct in trader of your trader business. So they remain 50% deductible. This is your travel. This is if you go out to a meal and you have substantial business discussions with whoever it is, a customer, prospect, whatever. Again, it's 50% deductible. However, I think you're going to be more apt to have to try to document what that business discussion was. They've now got this 100% non-deductible on the entertainment, and if we don't document our meals as what the business discussion was, I have a feeling they're going to call it entertainment non-deductible. They've got this. One interesting caveat I saw in this, or not caveat, but one interesting thing I saw when I was doing research for this that came to mind is charitable golf outings, which the chamber has, right? The cost of the meal and the golf, technically of the ticket, would not be deductible. It would be all considered entertainment. The charitable portion of it, the part that exceeds the fair value of what you received, would be deductible as a charity. So we may have to do some so.
Can I make a comment?
Doesn't mean that you still shouldn't support your chamber at the golf outing.
There you go. Thank you.
So what I really see happening with this is I don't see businesses changing what they're going to do. What I do see is businesses changing how they use this expense, because they're still going to do meals and entertainment. They're still going to entertain customers because that's how business is expected to get done. That's how you get business and so forth. But what I think they're going to do is instead of just giving out tickets to the shop floor guy, that's going to where I think you're going to see the stop. They're going to force the salesmen to go out and really use these as tools to get sales versus just kind of handing them out. I don't see them changing the impact of this. It's just a matter of where they do. So this is just a little chart. Give you some time just to kind of read it over on kind of the matrix of what's deductible and what's non-deductible. And I'm not going to read the whole thing, but again, we talk about the meals associated with entertainment activity is non-deductible. However, if it's a meal with substantial business discussions, then it becomes deductible. And again, I think documentation is going to be the key on that to get to that 50% deductible. The on-premise meals and provided by employers and so forth, that was at one point in time was 100% deductible. That's now 50% deductible. And then the holiday parties again is 100% deductible, or social events for employees. So maybe the chamber can hire all of us as employees for one day for the golf outing, and there we go. So net operating losses. So effective for the 2018 tax filing, they're no longer used to be able to take a loss that a business had, and you're able to either apply it back 2 years, and if you had income in those 2 years, you'd be able to apply for a refund and get some of that back, or you could take that loss and carry it forward and offset future income. Under the new law, the losses are no longer able to be carried back. They can be carried forward indefinitely, and when they are carried forward and applied to future income, they can only be applied up to 80% of income. Before, they used to be applied to 100% of income. Now they're 80% of income. So no matter what, even if you have a loss in prior years and you have income the next year, you're still going to have some sort of taxability in that future year. Okay. I don't know if we have any questions to so far, Kim?
I don't have any on this.
Okay. Okay.
I did. Hold on. Can I go ahead and ask this question?
Yeah.
I think. At the beginning, when you were talking about the professional services,
Professional Service Corps, yes.
right. So those are the PLLC, right? Is that what you're saying?
That would be typically they're PCs.
Okay.
They're PCs. PLLC is a professional limited liability company, and they could turn around and ask to be treated as a C corporation, but typically they're either LLC partnerships or they end up being S corporations.
Okay.
But that's what that is. But it's typically when you see something, so and so MD PC.
Right.
That's a professional corporation, and technically that is a designation as how you register with the state of Michigan when you incorporate your business.
Got it.
So you have to incorporate under because of what it is professional services such as I'm a PLLC.
Right.
I can't hide up behind my corporate veil for services that I perform to to if I was to ever get sued or something for services. So it's a different law. So I want to move on then to the qualified deduction for pass-through entities, or what's being referred to as Section 199A. This is where we go off the rails of the simplification that they try to do. What this deduction is we talked earlier that C Corps got a lower tax rate to 21%. However, pass-through entities pay tax at the shareholder level. So if I'm a shareholder of an S corporation or a partnership, I get a statement said this is my income and I have to report it on my personal return, and I pay taxes on my personal return at the personal rates. The concept behind that is to avoid double taxation at the corporate level. So, but if you think of when we talked about the rates, the highest rate now is 37%. So that gives a little bit unequalness between a pass-through entity and a C Corp, because the C Corp's tax rate dropped to 21%. So what Congress tried to do is give a deduction to these business owners to try to bring the rates a little bit more normal and online with C corporations. Okay, and so they came up with this Section 199A, or qualified business income deduction for pass-throughs. In its basic form, the deduction is 20% of your qualified business income, which is typically the business income of the entity. This also applies to Schedule Cs as well. So if you're a sole proprietor, it applies to anything that's a non-C Corp. So you've got your sole proprietors, you've got your partnerships, you've got your S Corps. All of those are pass-through entities that would apply. The big thing with this deduction is after you go through and calculate your normal taxable income. So what does that mean is that from that perspective, this is not a non-deductible item for the state of Michigan tax calculation, because the state of Michigan starts with your adjusted gross income. This occurs several lines down after that. So this deduction won't benefit the state of Michigan as the state rules are written now. And again, it applies to any businesses that are non-C Corps. So, okay. However, the Congress wasn't just going to let us do this just willy-nilly and allow for any business owners that have got $1 million come through and get this deduction right off the bat. Generally, what happens is this deduction is available for anybody that's got taxable income under $315,000 for a joint return, or $157,500 for those that are unmarried or single. If your income is over that, then you've got to go through several different steps to determine your deduction. Generally, if you're what they refer to as a non-service provider, which would be attorneys, accountants, doctors, lawyers, the only group that's excluded out of that is actually architect and engineers. So, but if you're a service provider, you can't take the wage portion, or use the wage calculation or the alternative calculation. So what happens is, and I've got a graphic that we'll go to in a minute here. What happens is you first have to look at your taxable income. If it's under 315, then you're fine. If it's over that, you have to look at an alternative calculation, which now takes into account part of your wages that you pay as an employer and part of the property that you own as a business, to determine the amount of the deduction. So it becomes a little bit more complicated the way it goes through, depending on your income. And again, this is taxable income. So this is after all of your tax and all of your deductions and everything to come to taxable income. So it does take into account itemized deductions and so forth. Back in August, I believe that the IRS finally came out with some regulations out on this. And they came out with, because one of the questions is what is defined as qualified business income or qualified business property? And you have to be in a trade or business. And so what the IRS did, not to get too technical, they relied on what's referred to as Section 162 of the Code, that says taxpayer must be involved with the activity with regularity and continuity. So what that means is passive entities, or if you're a passive owner in something, it may not qualify as qualified business property. Meaning, if you have rental property, the income from the rental property may not be part of this calculation, especially if you're sitting on a triple net lease and pushing all of the expenses over to the operating entity. Now, if you are active in real estate and an active participant in this, there's a chance that you may get qualified as part of it. but for the most part, the profession is indicating that rental property is not, the IRS is looking at rental property as not qualifying for the QBI. So that's a big, we were originally, when this first came out, we were thinking that it was going to be all business property, including rental. And then, so this was a kind of a little bit of a shock to us as we started to read the announcement. Okay, so I promised you a chart, and here we go. So, simplification, right? So, what you've got here is you've got you first start out as this a trade or business. And again, we start there and it goes based on Section 162, which means, are we active participant or are we active in the business? If yes, then are you a C corporation? If yes, no, it doesn't apply to C Corp. So if no, are we a service business? Are we a doctor? Are we an attorney? Are we something that's specifically identified in the regulations as a service business? If yes, then if our taxable income is under $315,000, we get the lesser of the 20% of our business income or our taxable income. Does that make sense? Kind of? I've got examples too. So this is where, if we got questions, this is where we're going to get them. So if it's not a service business, do we pay W-2 wages? Then we go through the deduction is either the QBI at 20% or the greater of a wage part of our wages and our business assets. If income is under 300 or over 315,000, if we're a service business, we start phasing out till our income's over 415, and we lose the deduction altogether. On a service business, if it's and if we get over 415, the service business loses the deduction altogether. At the end, is no longer available. If we're not a service business and we don't pay W-2 wages, and we're under 315, we get the full 20%. If we're over 315, again, we phase out to zero. However, if we pay wages, then we go through this alternative calculation. So it's not an easy calculation. It's a simple concept, but it takes a lot, and there's a lot of tax planning that can be involved, because the object is to, do you from a business perspective, how do you try to get your business under $315,000 in taxable income or your overall income? And this is at the individual level, remember. So the taxable income is combining with your spouse's income, husband's income, whatever. And so it's your taxable income will determine this at the taxpayer level, not at the business entity level, at the taxpayer level. So if you have a entity that, and I'll go through an example here. So this is a real estate agent that's making $150,000 in commission, has $50,000 as expense, and then has $100,000 of profit. Pays no W-2s because they're real estate. They wouldn't pay any W-2s, and has no qualifying property. Files a joint return with the spouse and has combined taxable income of $250,000. Since that taxable income is under the $315,000, they would get a deduction of $20,000, which is 20% of the $100,000 profit from the entity or from the business. Okay? If the taxable income was, instead of $250,000, was $75,000, then the deduction would be the $15,000 or the 20% of the taxable income. So there's a difference there. It's taxable income or what we're referring to as QBI, qualified business income. Okay? Another example. Real estate agent has $250,000 in commissions. I picked on real estate agents. $50,000 of expenses, net profit $200,000. Again, pays no wages or anything of that nature. Taxable income is $415,000. Since they're over the $315,000, they'd phase out. And they're over the $415,000, they'd phase out to zero. So they wouldn't get it. Now, if they had wages or if they had qualified property, they would get something. If the business had wages or had qualified property, they would get something based on those calculations of what those wages were. So for somebody like this, what you may want to do is you may end up, if this was a non-real estate and just a normal business that had $200,000 of profit, what you may want to do is make sure we're paying wages out to make sure that that becomes part of that calculation. So this is where the tax planning comes in from the tax preparers before the end of the year. And one last, this was just a planning idea. Again, picking on a real estate agent, $150,000 in income, $50,000 expenses, $100,000 profit, pays no wages or has qualified property. They have $330,000 of income. They're over the 315, so they start to lose it. So, but this is where planning ideas come into play. Can you now all of a sudden have the owner contribute to a retirement plan, a SEP plan or a SEP plan, make a $20,000 contribution, brings you under the 315. Now you get an extra 20% on top of that, and so you're paying $20,000 and you're saving $9,600 in tax. So you're getting a good bang for your buck. The other planning ideas, because of the fact that it's based upon the individual taxpayer, you may look at married filing separate as an option as well. So that's that again, and then this is where starting to plan and starting to figure out where as business owners, you should start contacting your tax preparers now to start trying to figure out what makes sense, especially if you're over that limitation and if you're at the higher income. So I did again, I had done this presentation for real estate, so I kind of picked on real estate when I did it originally to set it up. So some of the examples I kept in there. This is a real life example of somebody from 2017, 2018. They had business income of $116,000. They had rental losses of $6, almost $7. They had some deductions, so their adjusted gross income was just under $90,000. Their itemized deductions, 22. The exemptions, because there's four people. And so we can kind of see the comparison that their taxable income before the 199A actually went up $16,000 under the new law. So when I did my tax prepare for people this year, and I did some projections for next year, I would show people that their taxable income was going up, and they all freaked out. But at the end of the day, if we look at where their tax is, their tax before the self-employment tax actually went from $3,800 to $1,100. They're actually saving $2,700 under the new law, even though their taxable income went up. This has been most common for most people. Where I see the new law on an individual basis affecting people is going to be at those that have no kids, dual income, no kids, or retirees, or empty nesters, because they're going to lose typically they're going to see a little bit of an increase in their standard deduction, but they're going to lose their $8,000 or so in their exemptions. So they may see a little bit or very little impact to the law. I've seen some people that have had a $100 change, and it really wasn't worth it. So that's it.
Carrie Lynn McEvers says hello.
Okay, tell her. Thank you. So that kind of concludes what I had for this presentation. If we have any questions or concerns or anything that I went too fast over, that I know we've got a limited audience participation, but anything that you guys, did I go?
Where does rental, real estate, and landlord fit in those?
What?
Yeah.
Would you mind?
It's a great question.
Where does rental, real estate, and landlords fit into this?
So that's going to be based upon the definition of a qualified business. What the IRS has defined the qualified business is under Section 162 of the Internal Revenue Code, which says the taxpayer must be involved with the activity in irregularity. So depending on how you document how you're involved in this, if you're actively involved in managing the properties and actively running the landlord business, then there's a chance that we could get it as qualified business in activity. Okay. However, if you're just sitting back collecting rents and not doing anything and just kind of, then you would probably not be considered a trade or business. However, I would argue that if you're actively collecting rents, repairing, working, managing the property and things of that nature, you've got some aspect of your income as qualified business income. Okay. So it just depends. And again, the IRS has got rules relative to active and things. I think you have to have 500 hours of participation, or unless you're an active real estate in active real estate. So there's some things that you can do to do that, but I would document your hours for that. Yeah. Then if you've got over the 500 hours, then you would be fine.
Okay.
Yeah. So you must be considered active real estate.
Yes.
Then. Yeah. Yeah. Yep. Good.
Jamie, I have a question
Sure.
about the child tax credit.
Yes.
Phase out. What age? What age of the child?
It still remains under 17, under 17. So, however, I believe that it will go to $500 if they're still a dependent because of the fact that they're a non-child dependent now. So it goes to from the $2,000 to $500 as long as they're still a dependent.
That makes sense.
Yeah, good question though. Real good question.
Any other questions?
So it was about an hour. Okay.
So I just want to, one last time, thank you very much. Thank
You're
you
welcome.
to Jamie. That was wonderful information. And how do we get a hold of you if
I had this
questions
up and then I went too
popped up?
fast on the slide, I guess. But I'll put my confirmation. But they can get a hold of me. My email is james@capelcore.com. Our office phone number is 248-564-1410.
Okay. Well, thank you very much for tuning in, everyone. And also, I'm sure that you may have questions later on down the line because sometimes, they don't.
Yeah.
Yeah, until you start getting into the thick of everything.
Sure.
So, thank you for tuning in, and thank you so much
You're
for
quite welcome.
doing
I
this
enjoyed
for
it.
us.
I enjoyed it. Hopefully it was
All right.
value for everybody.
Wonderful.
Thank
All
you.
right. Thank you.